Hi, Gary here. How many central bank economists does it take to screw in a light bulb? Just one. He holds the light bulb while the entire earth revolves around him. All joking aside, we're at that time of year where we're reading everything about economic forecasts, and quite frankly, it's the proverbial, chimpanzee with the dartboard of the kind of results. Last year, at the beginning of the year, 45 out of 46 economists predicted that interest rates would go up this year, and the last one said it would be flat. Now, what happened? And they predicted about 0.6%. Actually, the reverse took place, and we're over 0.6% reduction in the 10-year Treasury bill. So, even with all these folks out there looking at our economy and looking at what they believe is going to happen, many times the information that we get is either useless or can be destructive. What do I mean by that? Well, in that last half of last year, that's June to December of 2013, $140 billion left the bond market, presumably because they pretty much agreed with what these economists said and didn't want to see their bonds go down in value. As it turns out, we have a year where bonds did fairly well. So even though the world thought that it would change and we'd have interest rates rise, it didn't take place. Now, will interest rates eventually rise? I'm sure they will. Timing-wise, it's hard to say. And the same thing is true about your overall portfolio. You put something in place structurally that fits where you are. If you're a young person, you're growing. You have more equities. If you're older and retired, you've got more income coming in. And you might be somewhere in between. You're trying to address inflation, or you're looking at capital preservation. There's lots of different issues. Anyway, you put this portfolio together to be able to walk you through a long period of time. In these shorter periods, these one-year periods, as we saw this year, who knows? So you don't jump out of bonds to thinking that it's better somewhere else and then lose out on a decent year in bond returns. Nor would you jump out of stocks if you thought the market was going down. Because every month there's some newsletter, some person saying that the whole world's coming to an end and the market's going to go down and everybody's going to lose all their money. And this happens all the time. And on the other side, there's somebody always saying it's going to be 10 times better than it is currently. So we, as investors, have to look at this and say, well, where do I fit? And it's really about starting to look at things, and from the past anyway, of how they look over the last 3 to 5 years. If you look at what happened in the last quarter or the last year, there's a lot of noise in all of that. But 3 to 5 years, the real numbers come out. And it's the same when you go forward, and you're forecasting forward 3 to 5 years in the future. You want to hold on to that structure. You want to hold on to how you, or what you need from a cash flow standpoint as far as that's concerned, and make sure you've got the right mix of assets out there. So yes, does it make sense? We're going to do our forecasts like everybody else. We're going to look at what we see fundamentally taking place in the market. But I know for sure the things we think are going to happen won't, and some of the things that we think are going to happen will, but I couldn't tell you which ones. And that's the whole thing about trying to make money more than the market averages out there. It's a very difficult game, and you always take a risk when you side with some short-term forecast out there. And we just see this repeating year after year. So stick with your plan, stick with how you've put your portfolio together, make sure there's nothing that'll go bump in the night relative to what's happening with your plan, and we can listen to the forecast and see what actually happens at the end of next year. So until next time, enjoy.